DJC, there you go.
DJC.
Tim MC and DJC, right. Even though we're not rappers or DJs. And anyway, we're right about to launch on Facebook Live, or whatever the heck you call that. So as soon as we do, we'll get the show rolling. We're going to be telling you what happens after the loan funds, and specifically we're going to be talking about what happens with the actual loan itself, or the note. There's a market for it. This is a lot longer than it normally takes to get going on Facebook. So we're definitely not live on Facebook yet. All right, here we go. 5. Hello, everybody. Welcome back to another episode of Finance Agents Live. This is episode number 70, or the second attempt at episode number 67. A few weeks ago, we tried to do this show, and we just got cut. I don't know, somebody in the NSA didn't want you knowing these awesome secrets and killed the show, but we're back. You can't stop us. This is Tim MC. I'm here with David CRANTZ, president of Lentera. And we're going to be talking about what happens after the loan funds. All right, so when something comes in here, we fund a loan, you might want to know what happens after the fact. And the interesting thing is, we don't just make money, and our clients don't just make money when the loan funds. There's opportunity after the loan funds. So that's what we're going to be talking about today. Now, if it's your first time on the show, what the heck, where have you been? Please subscribe, and you get more awesome conversations like this. But back into it, so we're talking about loans. What kind of loans are we talking about, David?
Every loan that goes through Lentera is a loan that when we fund a loan, we're talking about all those loans. Any loan that we've been dealing with falls into that category. Non-owner-occupied loans, obviously, our commercial loans, and the typical loans that you folks have been submitting to us.
All right, so these are real estate loans, and as you know, we're an equity lender, so we're looking at equity and giving money based on the equity. So what we have is a real valuable asset once we've actually lent that loan. You might be talking about a $500,000 note secured by a property worth $1 million, right? This is a great, Darren's looking weird, like maybe, are we online? Okay, all right. So this is a good asset, and it's a great loan for us to make, but then afterwards, there's still opportunity. So the loan funds, keep it going there, Darren, move it on. Move it on. So the loan funds, after the loan funds, we board it for servicing. What is servicing?
What that means is the people have to make monthly payments to us. We use an outside company that does our sub-servicing for us. So we take the loan after we fund it, and it's called boarded, or put together for the servicing agency to send out the proper notifications and to start to collect the payments for us. That's what they mean by boarding a loan for servicing. All
right, and typically somebody's first payment is going to be due about more or less 45 days after when the loan funds. There's some variance there. So somebody comes in, they get money, now they have an obligation, and we set them up with servicing, and they're going to start making payments on their loan. All right, so typically after they've made a payment or two, what are we going to do with that loan?
What we're going to do is we're going to sell that loan. We're either going to sell to our partner American Mortgage Fund, or we're going to take it and sell it off as an individual deed of trust or individual mortgage to an individual investor. So there's really two things that happen once the loan is boarded with our servicing company. It's sold to our partner American Mortgage Fund, or it's sold to a private individual as a investment security for the private individual.
All right, so if you haven't heard about this before, there's a huge market for this stuff. There's whole platforms out there where you can go buy and sell notes. So this is a security. It's got special laws around it that exempt it from other types of investments. So it's a whole asset class to itself. It's called mortgage investing. It's been around forever. And if you don't know about it, you might be about to find out about an amazing way to make great money on a highly secured asset with monthly cash flow. So you're probably going to love it. I sure do. So after we fund this thing, we give it to our partner American Mortgage Fund. And like I said, they're either going to buy it for themselves, and the investors in American Mortgage Fund will benefit from the monthly payments, or they're going to sell the note off to individual investors. And that is what we're going to be talking about today, because there's a lot to this, a lot of opportunity. If you're looking for a great way to invest, or you just want to understand the life cycle of the loan, we're going to dig into it right now. All right, so David, what are we doing today?
Let's talk a little bit about introduction to what mortgage investing is and what it's all about, and the benefits of investing in mortgages and trust deeds and investing in a mortgage fund. That's what I'd like to take a few minutes of your time today and explain what happens to the loan and the advantage of investing in a mortgage fund or buying a mortgage note directly.
So, you know, I heard about this about 7 years ago from my sister, whose in-laws have been doing mortgage investing for 20 years, and they'd been making a 9% return on their investments for literally 20 years without getting a single loss. And when I heard about that years ago, I thought, this is amazing. I got to get in on this. I either need to be investing this way, or I'd much rather have this service and offer it to other people. But I didn't know how to do that until I finally met David, who's been doing this for, how long have you been doing this for?
32 years this year.
32 years. So you started at birth.
17 years old. I'm an old guy.
All right. So he's been doing this for 32 years now. Over the years, he's had a number of different funds. I believe this is your 11th fund. Is that right?
I believe that to be correct.
All right. And you may be thinking, and this was new to me, why do you have so many funds? I mean, what's happened to all these? But each fund generally is going to have a short lifespan. It could be as little as a year. It could be as much as 10 years. But typically, your funds are, how long are your the lifespan?
Between a 2 to a 3 year term is what our funds are typically running.
Okay, so you do, say, a 2 or 3 year fund, and that way people come in, they invest, and then after that time they get their money out. They invest into the fund, and the fund is making interest payments. All right, so you've been doing this for 32 years, you've had 11 funds, and you have touched over $1 billion in real estate transactions, either through your funds or the lending that you've done, which is a lot. So you really know what the heck you're talking about. I believe at one point, total assets under management exceeded $300 million.
That's about right.
Right. So you've done this a lot. You know everything about it, the upside, the downside. So why don't you just talk about it? Well, why would somebody want to invest in mortgage notes?
There's a lot of reasons to buy mortgage notes. First of all, you're going to get a fixed monthly payment each and every month when you buy a mortgage. So you know what your payment's going to be each month when you go into get your mailbox or your ACH. Everything we do is secured by real estate. It's not a stock where you got a piece of paper and hope that Apple goes up, goes down. I think the market dropped 800 points one day last week or this week.
Right.
So, I mean, you can understand when you're looking at your money go up, down, up, down, up, down. This is a stable, fixed income type of property. And it's very lucrative. We beat the market. If you take what the S&P has done for the past 10 years and what we can do at 11% an American mortgage fund, you'll see how significantly more return you'll receive by investing in a consistent 11% return than you would being invested in any other type of property.
Okay, all right. So
or any other type of real stock, if you will.
Right, okay. So the first point, unstable, right? Most investments, you're going to buy something and hope the value goes up, kind of like you're talking about with stocks. And sometimes it goes up, sometimes it goes down. If you go buy a house, you're hoping that the market keeps going up, but it might not. It might crash, right? So there's a lot of uncertainty there. When you get the fixed payments with mortgage, that's great, but aren't you worried about maybe the person stops paying their mortgage? Why is this
happen
secure?
Because here's the deal. We have a loan in foreclosure right now. The properties were $650,000. I put together a first mortgage on it for $335,000. I'm not getting my payments right now. It's been about 4.5, 5 months before the guy made a payment, but my interest is accruing at a default rate of over 18% interest. So I'm okay letting my interest sit there for 4 to 5 months while I go through the foreclosure process, and my investors will really realize a huge windfall when we take this property back, or if indeed the guy pays off in a timely manner because of all the fees and default rate. So there's windfall opportunities in these deals.
Okay, great. So the key is we're doing a low loan to value, which means there's a lot of security for the investors.
Right.
All right, so if I wanted to participate in mortgage investing, in general, there's 3 different ways you could do that. One, you could go out and become a mortgage lender. All right, obviously, most people are not going to do that. You got to go get licensed. You got to learn how to make loans. You got to learn how to service loans. You got to learn how to find the deals. You got to be able to sell it. I mean, there's a whole heck of a lot there. Obviously, most people are not going to do that. So most people, that's not available. A second option is you can go buy individual notes. And we talk to people all the time that have been doing note purchasing forever. So that's a great way to go. But if you're just getting into it, how do you know which note to purchase? If you're looking at, you could come to us right now. We have about 15 loans. You could look at which one do you buy. It's kind of hard to know if you're new into it. So the easiest way to do it is to invest in a managed fund, and that's what American Mortgage Fund is. You give your money to American Mortgage Fund. They go select the notes, and then they pay you a fixed 11% return every month as long as everybody's paying, right?
Right.
Okay. All right, so let's talk about American Mortgage Fund a little bit. When was that founded?
We launched it in 2018.
That's this year.
That's this year. We launched it in March of 2018.
Okay.
We invest in nothing but mortgage notes that we buy from mortgage companies, particularly, especially from our own partner company, Lentera. And our average note rate in the fund is about 14%. So you can see with the 14%, we're certainly able to pay out an 11% return to our investors.
Okay, now I know a lot of people when they hear 14%, their question is, why the heck is somebody paying 14% on their mortgage? I've got my home at 4%. So what is that?
Well, that question is answered to me all the time. You got to remember, the type of loans we make, they're $400,000 loans on average. These people need the money quick. They're using our money to make money with our money. They can't wait 2 months to get a bank loan where they can come to us and get a loan done in 7-8 days. Once we have title and appraisal, we're ready to fund a loan. So it takes us days where it takes banks weeks. So a lot of our borrowers are using the money for an investment project or using the money for something in their business. They don't have the time to wait and execute their verification of income, their verification of their firstborn. They don't have the time for that. Right. We are an equity lender, and we look at what the equity is, and that's how we base our loans on asset-based lending, is really what we are as an asset-based lender.
Right, I just refied my mortgage, so I know what you're talking about. The bank goes through my bank account, line by line, asks me what every single transaction was for. It takes forever. That's not what we do. We're looking at the value of the asset, we get an appraisal, boom, if we can give you the money, we'll give you the money in 5 days. That's how our lending works. And so people are willing to pay a little bit higher rate in order to capture an opportunity that might be going away. So we have some specific examples we'll show you in a little bit. All right, so American Mortgage Fund. What they're doing in American Mortgage Fund is it's going out finding the best mortgages to invest in. So they're going to look through all sorts of different mortgages and say, this is the one with the best return and the most security, right? So they find the best mortgages. Once they buy the mortgage, they're going to manage the note servicing. They'll manage the payments from the borrowers. If there's a foreclosure, they'll go through the foreclosure process. And then they pay a fixed monthly fee to the investors. So what are the investors' responsibilities when they're in the fund?
Sit back, collect the check.
Sit back and get paid. All right, sounds good to me. Let's go through some of the numbers. What have we done so far this year? We're talking March, so it's
in March,
December. It's like 7 or 8 months now, right?
Yeah, about 9 months. We purchased $3.5 million in notes in American Mortgage Fund. So we're sitting with about $3.5 million right now in our fund. We've sold $3.5 million in that period of time in individual notes.
That's about even.
Just about even. Okay. And right now on our warehouse line of credit, this number is a little off. We have about $8.5 million, $8.6 million available to either go into our fund or for notes that we're selling off.
Okay, so we have a bunch of deals that are ready to go. If people come in and invest, it goes straight into the fund. There's no wait period.
That's right.
All right. Well, let's go over some specific examples of what's a deal look like, what are the kind of the notes that are in the fund, why would somebody, some more examples of why somebody would pay 14%. So okay. What do you know about this first example?
Well, this is a gentleman that has a $3 million house. He needed the money very quickly. He was in the middle of a contract, and he needed to borrow about $1 million very quickly for it to finish up a project, not his particular project on the home we lent down, but another project. He was a contractor. We were able to approve his loan literally and fund this loan in about a 5 or 6 day period of time. We're at 36% of the value of the house. I gave him $1.1 million against a $3 million value, and thank you, he's paying perfectly.
Right, and he's a great borrower. This guy owns his own winery, and he's doing these large real estate projects. But because the bank is very picky, if one of them gets caught up in something, he can't just go ask for more money. They're going to put him through a 3-month ringer and make him file his tax returns, who knows what. With us, he was able to get the money out quickly, and we get a good, high-paying borrower. All right, so here's another example. This is one that I really like to point out. Right here we have a business owner who had a couple properties, and he ended up getting into some bad business debts that had really high payments because he had to pay off the whole thing in 6 months at a high rate. His payments were through the roof. I think it was something like $20,000 a month he was paying. So we were able to pull cash out of 2 different buildings that he owned and cut his payments down to about $2,000 a month. I think we cut his payments by 90%. He's actually paying extra each month in order to pay down the principal, which he's not required to do, but just because he wants to pay everything off. So yeah, that's a win, right? It's a win for the borrower. He cut his debt servicing considerably, and it's a win for us. We get a good paying client, and we get a good return for the investors. So win-win-win. How about this last one?
Nice piece. It's a property worth $830,000 in North Dakota. It's a, believe it or not, it's a vacation home for this gentleman. He lives in Florida. He's a lawyer in Florida, and he uses this as a vacation home up in North Dakota. It's a beautiful home. Praised for $830,000. He needed the money for a business that he's involved in. We gave him a quick $375,000, and he's been paying so far. This was the guy that bought a property. He was using the money to buy a foreclosure at auction where he made a tremendous amount of money, made a big profit on it. So he didn't mind paying the fees or the interest rate because we got it done quickly for him.
Right, so he saw a great opportunity where you can pick up a property at about half its value. And so just by buying it, he made, you know, $300,000-$400,000. So who cares if it's 14% versus 8%, because the amount of money he made was much more. All right, so those are some good examples of the type of deals that are in the fund. What you'll see is that they're highly secured. Just, you know what our loans are like from Lentera. So you're looking at a 50% loan to value at a high interest rate, very secure. We've been making all our investors have been getting paid every month, all year, and we assume it's going to continue like that. So what kind of let's say you did invest. How about you give me an example of what that would look like?
No problem. So you put in $500,000. You're going to earn an 11% return. $500,000 at 11% is $55,000 a year. You get paid that monthly. It's $4,583 per month that you've just increased your net worth by an investment of a $500,000 investment. We pay 11% on anything that's above $100,000. And if you were to invest, let me go up the ladder a little bit, the $500,000, you'll see that your assets, you'll be protected by at least $1 million in assets. So we're going to keep you at that between $500,000 to $600,000. We're going to keep you between that 50 to 60% loan to value, as I explained earlier on the show to you, to keep a lot of equity in each deal we do.
Okay, and one of the great things about it, let's say you had $500,000, you could go buy one note, and that'd be great, right? You're getting your payments off that one note, or you can invest in the fund, and your risk is diversified across the entire fund. If you buy one note and that note stops paying, you're not going to get payments for a while. But you're not going to have half of the fund stop paying at once. So by being in the fund, you benefit from
diversification.
Your diversification across all the different notes. Okay, great. Well, if it's something you're interested in doing, then we have a contact slide we're going to put up here for our what's Neil's title?
Vice President of Investor Relations.
Vice President of Investor Relations. Neil's right there. There's his phone number. There's his email at neil@earn11.com. Send him some information. He can send you out the prospectus and figure out if this is something that would be a good investment for you. So who is this not good for?
It's not good for somebody that is not an accredited investor. It's not good for somebody that may only have $20,000 in their savings account and they want to put their whole $20,000 in. We don't recommend that. That's who it's not good for. It's just not good. You got to have some money that you can put aside and that you can be happy earning the 11% return on.
Right. You do need to be an accredited investor, and you can go look up what that means. If you're not sure, call us and we'll go over that with you. But if you're not an accredited investor, which is a legal definition from the SEC, I believe, then you could still purchase notes individually. You can even do partial purchases of notes. So there's a lot of options. If you're not accredited, don't be afraid to give us a call. There's still ways that you can make money investing directly in the notes that we have. All right, so unless I don't see any questions coming in, we'll go ahead and wrap it up for the day. David, thanks for coming on and explaining everything about mortgage investing. Again, if you're new to the show, subscribe. Come back next week and we'll talk about more amazing stuff. Thanks, everybody, for coming on. Look forward to doing a lot more deals together.